So just now we compare the terminology. The strike price, the exercise price, $1,000 in this case. On the stock market, that would be with option trading. It could be $2, $3, $5, $100, $400, $1,000. Sometimes strike price is very different. Now the premium or the option cost, because for some person it receive the money, for another person it's a cost, right? $50. On the stock market, it could be 10 cents, 5 cents, $5, also very different. Okay, now the underlying product in this particular case is handbag. On the stock market, it could be practically everything. It could be share, it could be index, it could be currency, it could be commodity, right? So we are going to look today at shares. Now, then expiry date here was a week later. On the stock market, US stock market, European stock market, and Australian stock market, they're a bit different. Okay, now. And if you look at US market, normally all options used to end up the contract third Friday of the month. Every third Friday they would expire. Nowadays it changed. At the moment you can have every week expiration. So some contracts they expire every week. So you can kind of sell this option for 1 week only. But also they can last in some cases for 2 years or even more. Now, in Australia, it's a bit different. Usually, it's the Thursday before the third Friday. That's how it works in this particular case. Now, and this particular option is the right to buy. Okay, so when the person buys this option, they buying the right to buy an underlying product. Okay, let's have a look now at a virtual example, first of all, in order to understand it better. So selling call option. So we bought the share. We pay $10. Now, when you trade options, usually it's traded in a bulk of 100 shares, 100, 200, 300, etc., etc. Normally, normal option. Now, for this specific example, we're just going to look at one particular share, but you understand when you trade in hundreds, you just have to multiply it by 100. Okay, so imagine that you bought a share for $10. Then you sell call option for 1 month with a strike price of $11 and receive a premium of 50 cents. Now, what it means, buyer pays you 50 cents for the right to buy your shares at $11 at any time during next month. Buyers believe that share price will grow up during this month and he or she will purchase it from you for $11 and sell it for a higher price with a profit. Okay, that's how it works. That's the reason buyer buys that. And of course, there could be two outcomes of this deal. And let's have a look first for your side, and then I'm going to show you another side, another person, in order for you to understand why that person buys it from you, because some people don't understand it. They say, why would he do it? You know, so if the share price is $10, why would he buy now, like and right to buy at $11? So, and I will explain you why it's working. Now, can you imagine you bought a share $10, you sell the option at share price 11, so you promised to sell shares at $11 and you got 50 cents. Now the question for you, when do you get this 50 cents? Do you get it initially when you're just creating this contract, or at the end of the contract? What do you think? Correct, Rick. At the start. Man, correct. Absolutely. At the start. So we get initially, it's same as rent. You get the rent from your tenants before they move in, not after they already lived for a month. Right? So that's how it works. So what can you do with this 50 cents? Can you use them or not? What do you think? Of course, 50 cents is not enough, but for example, if it is $500, Manna thinks that you need to have a guarantee. You have shares, right? You already have shares. You rented them out. So if you rent your property, what can you do with that rent? Assuming that you already paid off your mortgage. You can use it, right? You can do whatever you like. You can reinvest it, right? Because you have shares, you bought shares, you paid money for $10, so that's it. So assuming that you have no money at all, you have only $10. You paid $10, you gave it for the share. Now you have shares and have zero money. Then you rented it, sold the call, you got 50 cents. Now you can reinvest this 50 cents. You can buy more shares. Or you can withdraw it and travel to Bali. Or you can travel to Europe or whatever you want. Or you can buy some nice stuff for you. Of course, for 50 cents, you wouldn't buy much. But if it is $500 or $5,000, you already can do it. Right? So, and then already you look at possible outcomes. So if the price will stay below $11, profit 50 cents divided by your investment of $10 multiplied by 100, 5%. Okay, and you keep the shares. Now, the important thing here to understand that the cost of your shares is reduced now because you pay $10, you got 50 cents. Now the share price, the cost of your shares, $9.50. The question, guys, for you, if the share price doesn't move for the next like several years and you keep doing this strategy, how many months do you need to create this rental strategy in order to get your stock to zero? How many months? Who can calculate? If you get 50 cents all the time, 20 months, right? 20 months and it's covered. And then it doesn't really matter what the price of your shares. Now, if the share price grows above $11, and as a result, your share will be bought from you, right? So because that person is going to buy from you. For example, share went to the $12 level. Okay, they're going to buy it from you at 11 and sell it at whatever price it is. For you, it already doesn't really matter. So what your profit in this particular case, you're not getting 50 cents, but also you get the difference between buy and sell. In this particular case, it's $1. So you created $1.50, it gives you 15% return. Okay, you're reducing risk. Now, guys, especially who was trading, Rick, I think, was trading already shares. So, okay, William has experience, right? Then who traded? Rick as well. So the question is, Mana as well. So what the risks here? For you, for seller, what the risk? Remember I told you that I always going to talk about the risks. And for new people, if you're just learning, think about it. What kind of risk? Okay, so if the shares are called away, you get 15% profit. We're selling covered call. We already have shares, right? So here it's 15% profit. That's fantastic. You just increase you just got cash. Then you find another share and do the same trade. But Mena is correct. The risk of dropping down. Can you imagine that you sold the share call and then the price of that particular stock dropped down to $8? Okay, do you understand that? So the question is, how can we reduce that specific risk? How can we reduce the risk that the share dropping down? Because we made 50 cents, but share price might lose $2 in it. Please put pluses if you understand that specific risk, which exists here. And that's where a lot of option traders, they make mistakes and lose money. A lot of option traders, they sell volatility. They sell when the option premium is very high without understanding that usually it's combined with certain issues within the underlying product. Okay, and very often they can sell, they can get 5-7% on the trade, on the rent, but then the stock drops 20% or even more. Okay, and that's the question, how we can protect it. And the main reason here, or in the main way to protect it, is to choose quality businesses, quality companies. So I'm talking now about selling options for the certain shares. So if you choose the company which increasing profit, the company which is increasing their sales level, which expanded to different markets, innovative company, which is growing company, we understand that in majority of cases, these companies are going to stay in the market. They're not going to enter liquidation. It's one thing. Also, they're going to grow for the future. And even if the share price dropped 20%, for example, Intel, a couple of days ago, it dropped 16%. But if you look at the long term, Intel is going to recover. Intel is going to grow. So in this particular case, even if it drops, right? So you have to be sure that the stock is going to recover. It's one thing. Second thing, when we buy in order to reduce the risk, also, we buy companies when they're undervalued. You have to learn how to evaluate the company and how to understand if the company is undervalued or overvalued. We never buy overvalued company. Okay, we always evaluate the risk. It's like Warren Buffett. Warren Buffett just buy undervalued companies and then sell when they're high. Okay, in our case, we buy undervalued good companies and then we sell call options. Okay, you understand that, guys? Please put from 0 to 10 how you understand how to manage this risk. It's a huge difference. And if Rick is trading, I presume now he can adjust that part to this to your trading. Okay, in this particular case. Okay, we'll talk about it probably later. Okay, let's have a look at the second person. And option buyer calculations. Okay, the person who bought the option, why that person did it. So total risk is 50 cents. 50 cents control the shares for $10. Now, two possible outcomes. The price will stay below $11. Option buyer loses all the money because he paid it already. He doesn't have this cash on his account. Okay. Then if the price grows to $12, option buyer buys your shares at $11 and sell it at $12. So the profit is going to be $12 minus 11 minus 50 cents investment. So 50 cents. The profit is 100%. That's why that person does it. He doesn't want to put all the money. Actually, some people asking, but eventually he would have to put $11,000. No. When he does it, he just sell the option. It's just he gets this difference straight away. It's like one trade only. He doesn't actually have to buy the shares and sell it. He sells this difference to the market. Okay. So that person has risk of losing all investment money, but in a favorable movement have a chance of achieving high profitability. And there are a lot of people who on that side. Majority of hedge funds, majority of institutions, big traders, I mean, with a huge amount of money, $1 billion, they usually use this strategy. They are not going to risk all the investment money. They'd rather have 1 or 2% return a month, rather have 100, but the risk of losing all the money. Okay, this is kind of important stuff.